to Geared for Growth. I'm your host, Mike Mortlock from MCG Quantity Surveyors, and today I'm joined by Zoran Solano, a buyer's agent and property strategist, to unpack the opportunities emerging in a very different property market. Since the budget, sentiment has shifted dramatically, with many buyers and investors sitting on the sidelines waiting for certainty. But as Zoran explains, that hesitation is exactly what is creating some of the best buying conditions we've seen in years. We'll discuss why confidence, not fundamentals, is currently driving behaviour, what investors need to rethink around cash flow and strategy, and why quality assets in the right locations still matter as much as ever. We'll also explore the future of rental markets, the impact of fewer investors, why owner-occupier appeal is becoming increasingly important, and where opportunities may exist for those willing to take action. If you're trying to navigate the noise and make smart property decisions in 2026, this is a conversation you'll want to hear. Let's get into it. Zoran Solano, thanks for joining me back on Geared for Growth.
No worries, mate.
Now, at the time of recording, we're at the back end of July, and ever since the 12th of May, some of us have lost the spring out of our step. I wonder if you count yourself among that number and why.
Oh, mate, I would say that the spring is still in my step because I look at the silver lining and the opportunity this brings, right? As a buyer's agent, we have been wanting better buying opportunities now for several years, as it's been typically a seller-dominated market, or the power's been in the seller's hands. That's shifted, but the missing link is giving consumers the confidence to take action. I'm seeing deals out there that are some of the best deals I've seen in years, but it's having a client who has the intestinal fortitude to take action is the hard part.
That's the double-edged sword, isn't it? The deals are only good because people aren't wanting to take action, and you can only get the good deals if you take action. So it all kind of speaks to sentiment, right? And I was speaking to some people like yourself, buyers, agents, post 12th of May, and even though there hasn't really been any change in the owner-occ space, still owner-occupier activity and inquiry dropped immediately after. What do you make of that?
All comes down to that confidence, mate. And I think that while the legislation doesn't directly affect home buyers, you're right, it affects people's holistic decisions when it comes to property and wealth. And that might tie into what they're going to do with their principal place of residence. I'm seeing a lot of people who are sitting down going, hey, I was going to stay in my current home and buy an investment property, but the incentives to do so have lessened. Maybe let's just double down on the owner-occ and let's elevate to the dream home sooner. We're seeing a lot of that. So I think that for owner-occupiers, it may take a little bit of time. End of financial year, we always see seasonally a slowdown. But this year, it's definitely been amplified. I think people need to meet with their accountants, get some advice. But again, until only a couple of weeks ago, even those accountants didn't know what was happening. I think that the market's definitely it started to show signs of shifting, in my opinion, 4 to 6 weeks out from the budget. That's when I started to see the effects of a tipping point. Now, we actually met with the BOQ economists recently, a presentation, and he showed data that said, the market did start to slow in the weeks leading up to the budget. And in his mind, as a data analyst, he goes, oh, well, then it doesn't have anything to do with the budget. In fact, the market started to cool before the budget. But what economists and statisticians don't understand is that consumer confidence of a change looming, definitely started to make a change sooner than I think people realized.
Especially because this change was very well telegraphed and strategically leaked that it would change the property rules, right? I think in general, leading into a budget or leading into an election, people sit on their hands, but this one had to be turned up to 11.
Yeah, I've got a saying, mate. All you get from sitting on a fence is a sore bum. And all of those investors in the weeks leading up to the budget, I was telling them blue in the face. We're very likely to see grandfathering. I'd be taking action now,
Mm.
and a lot of them just sat, like a deer in headlights. And now, unfortunately, paying the price when it comes to the tax advantages of offsetting for that negative gearing. But in theory, if they've got the courage to take action, I'm buying properties for 5 to 10% discounts to what I would have had to pay in January, February, March. So there's an opportunity there for those who have the ability to cash flow the difference in the environment we're in now.
Now, I want to talk about investor side of things, but sticking with owner-occ, when I've bought owner-occ properties in the past, I've always really, in my heart of hearts, looked for a deal, something that would grow in value, because we're talking a CGT-free asset, so it's disproportionately valuable to get capital growth in your place of residence, but also because I think why not buy something that's likely to be worth more in the future than it is today? I don't think I'm unusual in that category. And I don't think it's just property people like yourself that would make decisions like that. Do you think that the fact that there's a bit of concern that we're going to have a downturn is a big reason why owner-occs haven't wanted to transact?
Mate, I think you give some people a bit more credit for thinking about the investment value of their principal place of residence. Because to be honest, I see a lot of people who really don't think about those considerations or historically haven't, and maybe they will moving forward. I really hope they do take a more level-headed approach to their principal place of residence. But mate, I think that there is definitely an opportunity for owner-occupiers to take stock and to get in and make some real gains when it comes to their principal place of residence. And I think this is going to be definitely the haven that, to be honest, the ATO is probably going to start scrutinising even more, right, moving forward, is to make sure that people aren't exploiting this because it's that sort of last remaining haven, so to speak.
Mm. On the investment side of things, when we look at the numbers broadly speaking, it's great news if your plan was to buy a brand new property because everything's kind of the same. However, the secondhand value of that property, it's hard to argue, isn't slightly a different valuation methodology than it was before. But if we're looking at established, we're basically looking at negative cash flow in a again, a dialed up to an 11 cents. What's your read about the pathway for investors that are still bullish on the future of value of property and the ability to leverage into an asset class that can give them the financial freedom they're chasing?
I think that there's a big fundamental shift in sentiment of investors. The expectations of rental yields are now higher than they were previously because obviously they have to cash flow it themselves. There's no benefit at the end of the financial year with tax offsets. So while obviously, as we all know, those losses are accumulated and offset in the future, it's the short term gratification and cash flow that obviously they're missing. I think what we're going to see investors do, quite sort of broadly speaking, they're either going to want the price of the purchase to be 100 grand less or they want the rent to be $100 more.
Mm.
You choose, but either way, something's got to give to make that cash flow more palatable for them because private investors are not going to cash flow government housing for the Australian government. So, the tenants are the ones who are going to have to pay for that at the end of the day, unfortunately. I think that it was a pipe dream to think that these legislative changes would have minimal impact on rents. We're already seeing the big impact on rents. I think that we're seeing historical investors who've maybe owned their property for 10 or 15 years starting to think, all right, maybe I'm going to cash in. So we're seeing a lot of people listing and selling their properties that are tenanted investments. But unfortunately, we're not seeing the new generation of investor replacing them. And that is evaporating rental markets from our rental properties from our markets. Simple year 10 economics tells us supply and demand factors will influence the value of a commodity. And so we will see, I believe, less investment properties put up to the rental market and start to push rents up. So investors will, I believe, be more aggressive at renewals, or at least they've got the right to do so, I think, moving forward. And I think tenants will be the one, unfortunately, that have to pay. Which could, prolong or kick down the can their ability to buy their own principal place of residence. So, I think that it's going to be very interesting when we start to talk crystal ball, which is probably where you want to go next.
No, I think anyone that's listening wants to know, where are the hotspots? Where do I buy? How do I make $1 million in 5 seconds? Of course that happens. But I want to adopt a different character and challenge you on something that I actually don't believe. And it's that you're wrong, because Treasury said $2 a week the rents would go up. So like one man in Brisbane against the might of Treasury, and I'm sure they have hundreds of employees and lots of economists who've got a lot shinier degrees than you do, Zoran. So,
Agreed.
I mean, how do you defend that position?
I'm at the coalface and I'm seeing it. Investors who have come on board post budget, and I've presented them opportunities. They've gone and basically looked at it and said, the rent's too low. We won't buy it. So, banks have taken a different position here as well. For anyone who has looked to get finance, in the last 6 to 12 months, banks have moved away from rental appraisals to conduct their serviceability calculations, and they're looking at signed leases. And so I'm coming across situations where a vendor might have a signed lease with a tenant $100 or $150 below current market because they were trying to be, good landlords. They were good tenants. Let's be good landlords. We won't increase it. We only increase it a little bit. And that's now coming to bite those vendors now, because ultimately for buyers, that $100 to $150 a week shortfall in rent is actually translating to a material difference in their borrowing capacity, which therefore means I'm offering less money for the property. So, this is all starting to bubble away and result in landlords ratcheting up rents to make their property seem more appealing on the sell side, or at least that's the strategy they should be adopting. Or, vacating a tenant, selling the property as a vacant property to attract a broader buyer demographic. But on the buy side, we're seeing buyers who are now taking on these properties going, great, hi, Mr. Vendor, my offer's 50 grand less because the rent's low, but in 6 months' time, that rent's going to go up to market rent. And, it's going to be like the frog thrown into boiling water situation. So, they might have fancy degrees, but they don't know what the reality is, I'm afraid.
Now, staying in character, just so you don't hang up on me, a very convincing rebuttal. Hard to pick holes in that one, even in character, which is the character that believes things that I don't believe as a human being. But we're trying to help first home buyers. So if the rent goes up, that's not really a problem, because with investors gone, everyone will just buy their property and home ownership rates will go through the roof and everything will be fine. I mean, you're just making a lot of hubbub over nothing.
Well, potentially, and I think you're right, man. I think that the market for established property has subdued. There is some more vendor discounting and time on market, and so I think that is resulting in some of the best buying opportunities we've seen in the last 5 years since COVID. First home buyers, this is your window to act. Interestingly, I don't know a lot of first home buyers who stepped historically straight into a brand new home as their first home. Most of us bought the crappy old renovator, and we lived with the cold house with no insulation, and we had to renovate and all that sort of stuff. And I think that's character building that the next generation might miss. But a lot of people obviously are looking at the incentives to buy brand new as an owner occupier. But again, do those properties exist where people want to live? Those outskirts, greenfield developments, or higher density units and apartments. But even the value of those properties are exceeding a lot of the caps that government put on these incentives. So I think there needs to be review in those elements as well if the government truly wants to help home buyers get into. I think first home buyers in my world at least, then that might be a small section of the market. They're actually probably in a stronger financial position than many realise to buy their first home. They've saved diligently. They've amassed a reasonable deposit. They may have access to early inheritance or parental equity for those fortunate enough to access those sort of benefits. Because we're seeing a lot of that older generation go, geez, it's going to be hard for the kids to get in the market. Let's help them out. And that's actually giving them capacity to buy something, potentially, 1.5 million as their first home, not the $700,000 first home either. So I think the government do, just to give them a bit of unsolicited advice, need to probably look at what the reality is out there in the market of those buyers.
Now I'm going to exit that character narrative and go back to myself and maybe argue with you in a real sense, and that I don't disagree that it's a perfect time to be a first home buyer, and the government has thrown the kitchen sink at you. Of course, these 5% deposits, we've been doing these stimulus things forever. CoreLogic's data has said, well, below the caps, we've seen, in the 6 months to March, nearly double the capital growth as above the cap. So it actually creates that same problem where we're kicking the can down the street sort of thing. But if you go back 50, 60, 70 years, roughly a third of people rent. So does the government actually think that we're going to get 3 million first home buyers buying a house and the rental market will shrink to the 350,000 public housing assets that they have in their portfolio? The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Mate, I wouldn't dare to imagine what a government person thinks in what a politician thinks. But mate, it's really hard to fathom. I think, just on a tangent, I think that one thing this will do is this will create a generational gap in wealth moving forward. The have and have-nots. The haves who have been able to benefit from substantial capital growth and negative gearing. And if anything, the fine print of the legislation actually gives that demographic even further opportunity to expand their portfolio, benefiting from negative gearing, given, obviously, for those who don't understand what I mean, you can still offset positive cash flow with negative cash flow if it's rental generated, not against your personal income. So, picture the 55-year-old, I've got my owner-occupier, I've bought one or two investments 10 years ago, those are now cash flow positive. Actually, let's go out and buy another property and we can offset the cash flow from the first two investments against the positive the negative shortfall of the third. The younger demographic are never going to be able to benefit from that, theoretically. So we're going to create this huge wealth gap, I believe, moving forward when it comes to people who've had the benefit of these incentives or not. So it's going to be interesting.
That's a very erudite point. And in the lead up to the election, that sort of seemed to be something that they were trying to solve. Take the money from the cashed up baby boomers and give it to the millennials. But sure, there's an argument to say, well, we've given some money to the millennials because we've made less competition with investors. But those baby boomers sail off into the sunset with a way better tax position and tax legislation than first home buyers today will have, right?
Correct. And I think as well, what a lot of people need to probably consider is a lot of people actually used previous tense, the rent vesting strategy to purchase their first property and get on the ladder. So they stayed at home, they rented out the property, they got some of the tax benefit, they got the cash flow, and then in subsequent years, they shifted and claimed it as a principal place of residence or used the equity growth to then purchase their PPR as a first home, but their second property. That window also has been slammed shut And I know a lot of people who used that strategy. Um, if you're of my era, when I purchased my first home, there was actually a cash grant for buying established property. I believe it was 15,000, so it was no stamp duty up to a certain value, and a $15,000 boost for established. Again, if we're truly trying to help people into a first home, something benefiting the established market, not just in the stamp duty, but potentially that. Obviously, we've got the 5% deposit scheme, which obviously could help that market. But I think that you see those historic. Benefits now no longer in place. You spoke about boomers. I think that more incentives to help the older demographic downsize out of homes that are no longer suitable for their needs. We call it right sizing. We have coined that term. Everyone can stay away from it. But we think that people need to consider how to help those demographic right size. We recently helped a 68-year-old lady. She was in a 1,200 square meter block of land, 5-bed, 3-bath house as a single lady. It's just no longer suitable. They become prisoners in their own home because they look at the cost of transacting property as such a lumpy asset with stamp duty and the agent commission, and obviously just even the emotional turmoil of downsizing, but not downgrading in quality. And it's a very traumatic experience, to be honest with you. It's a lifetime of memories in that house. But that house is what the next demographic of buyer needs,
Yeah.
right? If we can't build the homes fast enough, or they can't be built in locations that have amenity, then we've got to look at starting to push the first domino over to start freeing up housing supply in the established inner and middle ring belts for the next generation of owners.
That's a very, very good point. I've often heard people say that stamp duty is a tax on mobility, and getting people mobile means that they can right size and free up housing that better suits, a makeup where there might be 3 or 4 people in that home, way higher than the average, household formation rate. So I think you should be giving more unsolicited government advice. It's just a question of whether they listen. Let's go on to the investment side of things. Let's say we're not baby boomers. We don't have a positive portfolio that we can offset, a negatively geared asset. But we're listening at home and we're thinking, look, I'm renting by choice so I can invest, or I have my first property, but I want to invest outside of my principal place of residence because I don't believe that we're building it fast enough. And with immigration, that dynamic is showing, well, there's probably always going to be upward pressure on prices unless something really, really fundamentally changes. Where is the smart money going to go? If you don't have a huge budget, you're spending, $500,000, $600,000, $700,000 like your most average investors do, but you're facing assets that are $400 a week negatively geared. What do you think people should be doing, and where are the opportunities?
Yeah, I think that's the challenge, is that what can you buy for that kind of budget in, the established markets around Australia? There are really limited opportunities. Brisbane historically has been driven by its relative affordability to our southern cousins, but these days that's evaporated with capital growth. Obviously, that's my market, Brisbane and Southeast Queensland, and that market has seen such strong growth. So finding value at that lower price point, and buying what I would class as an investment grade property is exceedingly difficult. I believe the future aligns with what we've historically always said, which is quality over quantity when it comes to building a portfolio. I have an inquiry sitting in my inbox. They were saying, look, I'm keen to buy 3 to 4 investment properties valued between 5 to 700. So it's like, what you're talking about with that price point, over the next 12 months. My counter to that would be, would you consider purchasing less property in more premium, stable locations? Because if we look historically past the last 5 years and we go back further, a lot of those entry level markets they really suffered from poor average growth. You know, we didn't see consistency of capital growth. The consistency of growth, in my experience, centered around the inner and middle ring suburbs of capital cities, and that's where we saw that consistency from through my eyes. And so, moving forward, I think the opportunity in my mind is buying established property still in the inner and middle ring and improving the cash flow by looking to do a cosmetic renovation or refurbishment. Because again, we're seeing so many people being driven to the brand new house and land package, whether it's first home buyers or investors. That's going to shift, I believe, attention to those markets and leave this buying gap or this opportunity in the established market to leverage vendor discounting and purchase quality property that maybe is what I would call a bit of a diamond in the rough. And that's something that we've really specialized in as a buyer's agency, is the buying, identifying opportunities to value add and then assisting clients post purchase with renovations and value adding to then manufacture equity and increase cash flow. And again, that increased cash flow from a cosmetic renovation helps with the obviously lack of negative gearing now and helps improve that cash flow so that investors can start benefiting from stronger cash flow sooner. I believe that's going to be a real opportunity for diligent investors moving forward. And the trick is, it probably does take a little bit more effort than some investors want. You know, investors often are a little bit lazy. You know, they like the brand new off the plan because they just buy it in a catalog, so to speak, and put a tenant in and let's come back in 15 years. This strategy that I'm talking about is certainly a little bit more involved, potentially a little bit more cash flow intensive up front, with obviously having to fund a renovation from cash or equity you might be pulling from your existing portfolio. But I strongly believe the long-term gain will be there for those investors.
That's a very interesting insight. And before you started talking about the renovation value add, my question was going to be about yield. So let's say maybe these numbers don't really translate to Brisbane because it's had a bloody good couple of years. But let's say someone takes your advice and they move their budget of, let's say, $600,000 or $700,000, 700,000, and they want to get a couple of them, but they decide, well, we're going to go 1.1, 1.2. But the yield is going to be lesser on that higher value asset. So I mean, first argue with me if you think that that's incorrect, but that value add is actually probably getting it to the point where it at least matches that and hopefully even overtakes the yield that you would see on a lesser cost asset.
Yeah, potentially. You're not wrong. As we go up to that, so call it 1 to 1.2 price bracket, the yield as a percentage does drop down a little bit, for sure. But then, as I said, yeah, the counter argument or the counter strategy to that is that cosmetic renovation or refurbishment, to help supplement that and help improve that performance. So that's definitely a strategy we're seeing. Again, it comes back to each investor has a slightly different strategy, and they come into the situation with different financial capacity, whether it's borrowing capacity, access to cash, access to equity. And so some might find they need to really be diligent on that lower budget, stronger cash flow property. But what I think they will see is subdued capital growth compared to that more premium market, still around the median house price of Brisbane, circa 1.2. But again, I think we need to remember as well, if the owner occupiers are going to start to become the more dominant influencer of the Australian property market like it historically was, then we should be buying where owner occupiers buy, not where investors would typically want to invest. Follow the investment fundamentals of an owner occupier's psyche, not the investment fundamentals of what a lot of investors look for. And it's always been our philosophy. We look for high owner occupier to investor ratio. We look at properties that, when you need to sell, we want to sell it to an owner occupier who becomes emotionally invested in that property. This is often why we actually shy away from granny flats, dual occupancy, dual living, rooming accommodation, all of this sort of stuff. has traditionally been not something we assist clients in purchasing because it's so pigeonholed to investors. You know, you even just have to look at the way banks assess those type of assets more critically than just a beautiful 4-bed, 2-bath, 2-car, low set brick and tile, you know, on 600 to 800 square meters in God's country, middle ring suburbia. You know, banks love it, so investors should love that too, in my opinion.
That's a really good point, because I suppose, like, even at the peak of investor activity, we're still not 50% of transactions. In fact, we get to 40 or low 40%. APRA actually intervenes in the market to smash investors back down. Long-term average, it's going to be 3 out of 10 transactions go to investors and 7 out of 10 go to owner-occupiers. So why not find something that's going to appeal to them, because we know that they will pay a premium because they're more emotional, and, you know, it's not just a number on a spreadsheet, it's where they actually live, right? So I think that's great
Correct.
advice.
Yeah, and I think that just circles back to what I mentioned earlier about, you know, again, I don't know the stats, but you know, we are seeing a lot of investors now looking to realize their capital gain and sell their current investment properties. And if we look at who that is going to, as you just said, it's maybe going to 70% chance it's going to an owner occupier. So 7 out of 10 investment properties being sold, evaporating off the rental market, leaving 3. You know, I want to be those 3, right? Because I want those 10 tenants to fight over the 3 properties in theory, you know. So again, though, I think that the era of the slumlord is gone, as in, you know, investors need to invest in maintenance. Tenants often, you know, if they're going to be tenants moving forward, outside of all these government initiatives to buy their first home, if they're still truly wanting to rent as a lifestyle choice, they want quality, you know. So investors do still need to maintain their properties. And I do fear, with the removal of negative gearing, removal of, you know, obviously offsetting, you know, depreciation, you know, and those sort of elements as well, we could see investors go, well, why would I spend money on the investment property? You know, I think those that do will be rewarded. I think those that don't will have a stark reality check when their rents do sort of still stay stagnant. And then when they look to sell, you know, I can't tell you the amount of times I've bought a property and done a building and pest, and I've educated a vendor about the condition of their home more so than their property manager or selling agent has ever done.
Yeah.
What do you mean? What do you mean it's leaking? What do you mean that that's falling off? No one's ever told me that. And it's like, well, why did it take a buyer's agent doing a building and pest or a personal inspection to tell you about your own property? You know?
Yeah, and you raise a good point. I mean, we've got the new census coming out very, very soon, but the last one said that around about 27% of working age adults are in property or property related services. So investors, if they're not wanting to do maintenance, it flows through to all of the people that get fed on that work, and also transactions as well. And I can't see anything in this policy that's going to increase property transactions, but that's maybe a whole nother episode where we talk about a potential recession.
Mate, I think as well, if the government was truly committed to stimulating employment opportunities for the labour force, why not include renovations of established properties to be able to be negatively geared, or to have that tax benefit as an immediate offset rather than an accumulative one? Because, you know, I might buy an investment property for a client. On average, I think if they adopt our buy and renovate strategy, they're probably spending somewhere in the vicinity of 30 to 50,000 post settlement on a renovation. You know, that's directly paying the wages of electricians, plumbers, painters, flooring companies, you know, landscapers. You know, so you know, we are stimulating those, you know, renovations and employment in the labour force, just in a different way to a brand new product.
Look, very, very sensible points there, mate, and even in character, I couldn't fault you with the stuff that you've shared today. You prefaced in the beginning that people sitting on the fence are most likely to get a sore bum and nothing else. To finish us off, what do you think in terms of investors? that we should be doing right now for people that have the ability to transact in 2026? What's your best bit of advice for them?
I think that everyone always tries to search for the bottom of the market to buy. It's impossible to know when the bottom of a market is until it starts to rise up off it. And then once that starts, it's the sheep mentality and everyone jumps in. You know, when the Uber driver or the media tells you the market's rising, it's too bloody late. So I think that it goes back to the fundamentals that if you have the capacity to buy, get the pre-approval, seriously look at your capacity. Don't settle for second best. Make sure you're searching for quality, because no matter what the market is doing, quality will always transact. Making sure that the property doesn't have hairs. Staying away from the busy roads, the flood affected, the train lines. Go back to those core fundamentals to make sure that no matter what market you're selling in the future, that there is as minimal amount of objections that buyers can present to you so that you could sell to a big audience. Again, I say sell when we buy because we're always thinking about what is the strategy later on. So yeah, my closing advice would be take action. The top of one market cycle is the bottom of the next if you look at historical data in Australia. And while I think the next property cycle will be longer and more drawn out with slower rates of capital growth, I think there's still opportunity for growth in our market with the right asset.
I love that. What a way to finish, and I couldn't agree more, mate. Thanks for sharing all of your time and your wisdom today.
No worries. Thank you.